Welcome back to Click Capital, everyone, and in today's video we're going to do a deep dive into Disney and perform a stock analysis and stock forecast. So stay right through to the end and I'll give you our final rating and price target on the Disney stock after we look at all the fundamentals, valuation and technical charts as well. You can see here this is a monthly chart on Disney going back 10 years ago. So around 10 years ago we were around $50 a share, and then after a long bull market we got up to just over $200 a share, but now we've pulled back over 50% and we're now sitting at $100 per share in Disney. So is Disney a good buy here at $100 per share? Stay with us today and that's what we're about to find out. So today's stock analysis will cover a comprehensive 5-step process. First, we'll look at the latest news and analysis at Disney. Then we'll look at some Wall Street analyst and quantitative ratings. Then into corporate insider and hedge fund buy and sells. Then we'll dive deep into the charts and perform some technical analysis. And stay with us right through to the end. We'll give you our final rating and price target on Disney and let you know our opinion on whether we think it is a good buy here at around $100 per share. So you probably already know about Disney. Most of the world does. It's a 100-year-old company, the biggest entertainment company in the world. After starting with a simple Mickey Mouse cartoon 100 years ago, they have grown into a giant collection of entertainment assets and properties around the world, including their main ones of Disney movies and Pixar, Marvel, Lucasfilm, 20th Century Studios. They've also got big theme parks with some in China as well. They operate Disney cruises, have Disney resorts, weddings, TV channels like ABC, Disney, ESPN, Nat Geo, A&E, History, Vice. And the big one they're pushing, you can see on their website here, is Disney Plus. They also own a lot of Hulu. They have Disney music and Broadway shows like Lion King, Aladdin, Frozen. They have Disney merchandise. The list goes on and on. They are the Berkshire Hathaway of entertainment assets. And in the big global market of streaming content, they are a number 3 player just behind Amazon's Prime and Netflix. And Disney have one key advantage in the streaming business, in that they have a huge content catalog from over 100 years of producing content, which should help them maintain a strong presence in the global streaming market going forward, along with high operating margins. Their share of the box office has been growing over the past 20 years as well, as they come up with bigger and bigger blockbuster movies and continue to invest in storytelling technology and acquiring the most high quality assets. Over the last 5 years, they have showed impressive revenue growth, growing from $55 billion to $82 billion last year in revenue. Okay, so now we'll perform some analysis using Seeking Alpha. And for those of you who don't know, Seeking Alpha, in our opinion, is the best stock analysis platform on the web, as it doesn't just give you all the latest numbers, it also has the biggest community of highly qualified and experienced authors who regularly contribute to the site their opinion and research pieces on just about every stock out there. If you want to sign up for a 7-day free trial of Seeking Alpha, click the link below this video. And if you do decide to upgrade after your 7-day trial using our link below this video, you'll get you a 58% discount, so only $99 a year to access all. And stay to the end of this video, I'll tell you how you can get 2 of our custom indicators that we're going to be using in today's analysis for free when you sign up for Seeking Alpha using the link below this video. Okay, so let's get right into it. So we can see here we're currently at 182 billion market cap, and we'll use Seeking Alpha to go over some of the most recent news out of the stock, and then we'll look at some bullish arguments from some authors and then some bearish arguments from some other authors to give you a balanced view of the stock. So bank analysts are warming back up to the stock again with the recent return of CEO Bob Iger. Bank of America has boosted Disney's estimates and saying they are bringing the magic back with decisive actions to cut costs, give creative control back to executives, and return a greater emphasis to their core brands, including ESPN. Some people have speculated that Apple could buy Disney, as they're probably one of the very few companies in the world with the balance sheet that could pull that off, and some people saying that the two together would create a lot of synergies and they would be worth more combined than separately. But I'm not so sure about that, because at a current valuation of 182 billion, Apple would likely have to offer more than 200 billion, and even for Apple that is a huge bill to get all shareholders on board with. And much like many other companies, and especially in the tech space, Disney has announced 3 job-cutting rounds, which the market has liked. In addition to Bank of America, JP Morgan likes Disney as well. They reinstated them at overweight, expecting slower streaming losses. And JP Morgan has got that as Disney as its favorite name in the media landscape. That's due to a strong asset mix and what we expect to be a rapid decline in streaming losses in the next year. On the company's earnings call, CEO Bob Iger outlined a transformation program centered on rationalizing the streaming business, $5.5 billion cost-cutting program, and empowering creativity. And after a lot of people for many years been calling for Disney to spin off ESPN, it looks like they're focused on making that work along with the other assets, which JP Morgan seems to like. And here's a bullish argument from an author who says why he's betting on Bob Iger. He has conviction that Bob Iger will benefit the company's value given his track record of smart strategic moves. The company's high brand recognition and loyal fan base should drive demand for its products and services, and he's suggesting the valuation has got it as undervalued. And he's basically saying it's a compelling investment opportunity for long-term investors. This article talks about David Tepper, a well-known hedge fund manager, has bet on Disney despite being net short on equities. And he's showing here a growth of global Disney Plus subscribers, and I think this is a big benefit to Disney as well. Getting into the streaming market makes a lot of sense with all their content. So I think this gives Disney as a whole a bit of a tailwind as well with their Disney Plus business. And with the Bob Iger coming back to head up the company, a lot of people are liking that, including hedge funds and analysts. And this author's saying the same thing as well. Bob Iger's turnaround and cost-cutting and restructuring should help drive profitability amid a challenging macroeconomic environment. And that's the thing. We've got indicators saying we're coming into a recession shortly in the economy. And you got to remember, a business like Disney is quite levered to discretionary spending. They're not selling things that we absolutely need to survive. It's more for wealthier consumers and those with discretionary income to get some entertainment products. So in a recession, their sales, theme parks, movies, merchandise could well and truly dip. However, that may present another opportunity for a long-term investor as well. However, there are other risks for the business as well, as this author makes a bearish argument and points out Disney's cable channels heading for a cliff. With the focus on streaming, the market is too complacent. The risks surrounding their legacy cable channels, which comprise $8.5 billion of their $12.1 billion in total operating profits. Despite record cord cutting, Disney has been able to maintain their cable network's profits by increasing prices to offset subscriber losses. But this isn't a sustainable strategy. The industry is at an inflection point. Sports content, the glue holding cable together, is set to be released as standalone streaming options this year, allowing fans to bypass cable. This could accelerate cord cutting, causing the cable networks to experience a big decline than most had anticipated. That's a really good point. They are holding these old big assets, their TV channels like ABC, Disney, ESPN, Nat Geo, A&E, History, amongst a bunch of others. And those are in structural decline as the industry switches from cable to streaming. So they may struggle to ever grow them again. And the author's right, they can't just keep increasing the prices forever. And they may not ever find anyone to acquire those assets as well. So they may just be dwindling down on the balance sheet for years to come. And I'd say that's why they invested so much into Disney Plus and are really trying to push that out to counteract those slowing traditional media assets they have. And this author is making a bearish argument, saying that creating a new corporate culture is job one for Iger. And he's saying that their great strength was its internal creative juices, but it's lost that mojo and opted to pay huge premiums for established icons. There has been some controversy with the price Disney has paid for some assets, and some other things in the company similar to Netflix to do with woke culture has been controversial as well. But taking a long-term view, I don't think this should have too much of a negative impact on Disney. And Bob Iger will adjust to whatever works and produces profits going forward. And this author's making a bearish argument and saying there's uncertainty under Iger, so him coming back and firing the old guy is a sign of weakness. And there's been a lot of confidence shaken amongst the stock and their key stakeholders, which there's some truth to that. But this could be setting up for a classic turnaround, because of those things. And Bob Iger has proved himself over the years with a really solid track record of what he's done at Disney. So there's no reason he can't come back and steer the ship in the right direction once again. And looking at what corporate insiders have done in the Disney stock, it appears there's only been a few sells this year, with the largest coming from the CFO back in January for 4.1 million, and another one for 1.7 million back then as well from another insider. So not a whole lot of activity to report there. Hedge funds are generally positive on the stock. The biggest holders of Disney stock have all added in their most recent reported dates. So overall, the largest holders have been increasing their position in Disney. Okay, let's look at some data. Let's dive into the charts. Okay, so this is a monthly chart of Disney going back 10 years, and we can see some key support and resistance zones. So we can see a big support zone right around that $90 level that's been in effect for about 9 years now. And the next key resistance zone is about that 110 level that again has been in effect for a very long time. So these are the two immediate big levels that we'll be looking for to hold or break. We'll be looking for support around those low 90s and for resistance around 110, 112. A break above this resistance could indicate a new uptrend after this consolidating accumulation base. So ever since June last year, the Disney stock may be attempting to put in a solid base here. After low 110s, we could expect the next resistance to be around the 140 level to 145. And again, another slight one around the 160 level. Compared to many other large, well-known brand stocks, not many are down near their prior COVID lows as Disney is. So technically speaking, this has been very oversold, coming off $203 a share, getting down to $84 a share, and rebounded a little bit here, just currently sitting at over $100 per share. Looking at our fundamental chart, we can see on our stock fair value that we've got fair value at $134 per share and business quality score at 2.5, which is about average when we want to see that number stay above 0. So for our rating and price target on Disney, since Disney is a high quality business with what could be argued as one of the most well-known and valuable brands in the world, we believe they deserve a premium over our stock fair value indicator. So we're going to go ahead and give it a 20% premium, and that takes us to $160 per share. So $160 per share gives us a potential 60% gain from where we are now, and it's where it was last trading in January last year. And if we do a Fibonacci from the big move down, we can see that 160 levels around a 61% retracement, which we often see when stocks do eventually retrace. So for now, at $100 per share, we're going to give it an outperform rating with a price target of $160 per share. And if you'd like to get our custom indicators, stock fair value and business quality score for TradingView free, just sign up to Seeking Alpha using the link below this video and send an email to us at support@clickcapital.io along with your name and TradingView username, and we'll give you access to our stock fair value and business quality score indicators to keep using at no ongoing cost. And then you can just keep monitoring Disney with it and set up an alert for when the stock goes back to above fair value. And you can also use these indicators on every other stock around the world to see what's cheap and which is expensive and when to get out when stock comes back above fair value. So that's it for today's video. Thanks very much for watching. If you found some value in this, please hit the like button and subscribe with notifications to get more videos like this. Thank you.